Greetings, fellow traders. I'm Dylan, a research strategist at Pepperstone, presenting the latest weekly update on As Good As Gold. So overall, gold has performed impressively in 2023, gaining over 13% against the dollar, marking the best in 3 years. Entering the Christmas season, the upward momentum in prices continued until a slight pullback occurred in the most recent week. As the new year has just begun, there are still very limited trading signals in the market, and investors are waiting for the release of the Fed meeting minutes and the non-farm payroll this week to adjust their risk exposure to gold. So firstly, let's briefly review the development of the gold against US dollar daily chart over the past 3 weeks. Gold prices were lifted back to the critical level of $2,000 in the middle of last month, and after a slight consolidation, welcomed Christmas with a steady upward trend. On December 22nd, gold broke above the high point of April last year at 2048, closing above the 5-day EMA, and in the following 3 days, it breached the significant resistance zone of $2075 to $2078, a level that had been repeatedly tested and proven effective over the past 3 years. And after briefly touching a high of 2088, the price underwent a downward correction and is currently trading around $2060 per ounce. On the downside, there might be a large influx of buyers around 2048. If this level fails to hold $2022, the 23.8% Fibonacci retracement level of the upward range from early October to December 28th last year may offer further support. And the pressure near 2075 to 2078 remains a focus, and if prices return to the high of $2088 a few days ago, gold may challenge the 2100 mark, thereby opening up more significant upward space. And exploring the reasons for the price fluctuations, the lower than expected core PCE inflation in November in the US provides part of the explanation. The cooling of inflation indicates that the underlying price pressures are easing, affirming the financial market's expectation of a Fed rate cut in March. However, more than macroeconomic data, I believe the dominant factor is the holiday effect, where reduced liquidity leads to increased price volatility, with the market driven more by a small amount of capital flow than by new information. While looking back at gold's excellent performance in 2023, the market's pricing in the Fed and other developed market central banks' imminent rate cuts pause, and the frequent risk events such as the US banking crisis and the Middle East conflict are the two main reasons behind it. And these two factors are likely to be the key in affecting this year's gold trend as well. Although rate cuts are already a consensus, there is still uncertainty over when and how much the central banks will reduce rates, potentially providing speculative opportunities for the market and causing short-term fluctuations in gold prices. And as rate cuts take place, with real interest rates falling and the dollar losing support, gold prices are expected to rise. Meanwhile, yesterday's U.S. demand for an early implementation of the AFSL ban on China cast a shadow over the Sino-U.S. relations on the first trading day of the year, along with the escalating situation in Ukraine and Russia, and also the uncertainties of major shipping chains return to the Red Sea plan, all of which are favorable factors for gold. And from a macroeconomic perspective, the market still has concerns about possible recession this year, and the global de-dollarization trend may encourage an increase in gold positions in investment portfolios, thus supporting gold's performance. So in summary, the recent fortnight's fluctuations in gold prices are more of a reflection of the lack of liquidity. In the long term, the developed market central banks' rate cuts and geopolitical conflicts, among other event risks, are crucial to gold's overall performance this year. While policy differences and out-of-sync rate cut paths among different economies may cause brief fluctuations in gold prices. This week is also a super week for gold, with the Fed's December meeting minutes on Thursday and the non-farm payroll data on Friday being crucial to gold's short-term trend. As the U.S. swap market fully prices a 25 basis point cut in March, traders will closely monitor the minutes for more details on the willingness to lower the federal funds rate. And if the minutes convey dovish information similar to the post-FOMC meeting and the Powell's statement in December, it inflation may boost gold prices, or a strong US dollar may still be in play and harm the gold. Incidentally, the US CPI data on the 12th is also likely to work in the same way, unless it really surprises us to the upside. The first cut in March will be the case. And the non-farm payroll report is forecasted to add 168,000 jobs, with the unemployment rate expected to rise from 3.7% to 3.8%, and the average hourly earnings slightly down to 3.9%, depending on working hours. And if the data is better than expected, the dollar might rise sharply, surprising gold prices and vice versa. So that's all for this week. Stay tuned with Pepperstone for more insights and updates, and hope everyone has a successful trading year ahead.